Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. In previous video, we looked at how the market moves in trends, forming swings high and swing lows. Now in this video, we want to quickly look at how traders relate with these trends and how they look at this trend in an attempt to seize market opportunity. So in this video, we'll be looking at trend lines as well as how traders can maximize market opportunities using trend lines. So basically, a trend line is a charting tool basically that is used to illustrate the direction of a trend. In an uptrend, a trend line is drawn by connecting the lows of the trend, which is the higher lows of the trend, and serves as an imaginary support levels for traders. So traders who trade trend lines in a bullish market, in an uptrending market, would be looking to buy every time that prices return back to the trend line. It serves as imaginary support to those traders. In a downtrend, however, a trend line is drawn by connecting the eye of the trend, the lower eyes of the trend. Remember, every trend is defined by swing points of highs and lows. This trend line serves as resistance where the trader looks to sell every time that price approaches the trend line. One thing to have in mind is the trend line is a construct of the trader. It is an imaginary line that is drawn on the chart. Because a trend line is drawn doesn't necessarily mean that market is going to bounce off or reject from that price level every time it gets there. Don't forget that trend lines are imaginary lines. They are constructs by traders. Now there are two ways to trade in the trend line, which we are going to look at. Firstly, traders look to trade trend line by trading in the direction of the trend. So what this basically means is that in a bullish market, a trader is going to extend his trend line and look onto it as an imaginary support level where he expects price to bounce off whenever price comes to that point. While in a downtrend, the trend line serves as a resistance which pushes price down every time the price approach that level. So in an uptrend, traders will be looking to buy whenever price approach the trend line, buy as support, while in a downtrend, traders will be looking to sell the trend line as resistance level. One golden rule among trendline traders is for every time a trendline is tested and respected, the stronger the trendline becomes, regardless of whether it is a bullish trendline or a bearish trendline. Meanwhile, there's also the assumption among trendline traders that when a trendline fails, it feels big, it feels hard. So there are those traders who would wait for a trend to fail to trade in the direction of the opposing trend. So let's say we have an uptrend and a rising trend line, and then that trend line gets broken. Now for a trader who trades trend lines and breakouts, he would basically be looking to sell instead of to buy. Yeah. The same is applicable in a downtrending market where prices break to the upside. Now, such breakout traders will be looking to buy instead of to sell. So guys, I remain Monaco Daniel, the mastermind trader from the world's most populous black nation. See you on the next video.